What if I told you the Federal Reserve just handed you a roadmap to potential profits? I'm not talking about some complicated trading strategy or insider information. I'm talking about a clear signal that Federal Reserve Chair Jerome Powell sent in September 2025 when he acknowledged that the balance of risks in the economy appears to be shifting. That simple statement triggered something massive in the financial markets because what it really meant was this: the era of rate cuts has begun. Right now, the Federal Reserve has kept interest rates in the 4.25 to 4.5% range since December 2024, but that's about to change dramatically. They've already made their first cut of 25 basis points in September, and here's what most people don't realize. The market is now pricing in an 80% or higher probability of additional cuts coming soon. This isn't speculation. This is what the actual bond markets are telling us. But here's the critical part. Unemployment just hit 4.3% and is rising. Job creation? Only 22,000 new jobs were added in August, well below what economists expected. The Fed is no longer fighting inflation. They're now worried about supporting economic growth, and that changes everything for investors. Now, I'm going to reveal 5 specific ETFs that are positioned to potentially thrive in this new environment. These aren't random picks. Each one is strategically positioned to benefit from falling interest rates in a unique way. And here's the best part. I'll show you exactly how to position yourself before the next cut happens, because timing matters when it comes to capturing these gains. Now, before we dive into the specific investments, you need to understand why this moment is so important. The Federal Reserve spent years fighting inflation, raising rates aggressively to cool down the economy. But now the script has flipped. They're pivoting to support growth, and this creates a domino effect that savvy investors can capitalize on. When interest rates fall, borrowing becomes cheaper. That means businesses can expand more easily, consumers can afford bigger purchases, and suddenly assets that were less attractive during high-rate periods become incredibly appealing. Think about it this way. If you could lock in a 4% yield today and then rates drop to 3% tomorrow, your investment just became more valuable. Everyone else is stuck getting 3%, but you're still collecting 4%. That's the power of positioning yourself correctly before rate cuts happen. And it's not just about income. Lower rates mean asset prices tend to rise across the board, from real estate to stocks to bonds. So who wins when rates fall? Real estate wins big because cheaper mortgages mean higher property values and REITs can borrow money for less. Long-term bonds become premium assets because those locked-in higher yields suddenly look amazing compared to new, lower-yielding bonds. Dividend-paying stocks become more attractive because when bond yields fall, investors hungry for income start looking at stocks with solid dividends. Consumer companies benefit because people buy more cars, more homes, more of everything when financing costs drop. And small-cap companies, which often rely heavily on borrowing for growth, suddenly find it much cheaper to expand their businesses. The historical data backs this up. During previous rate-cutting cycles, these exact types of investments have consistently outperformed. The Fed is essentially creating a tailwind for specific sectors of the market, and I'm about to show you exactly how to catch that wind. So now that you understand why this matters, let me show you the 5 best ways to capitalize on this opportunity. Let's start with number 1, the Vanguard Real Estate ETF, ticker symbol VNQ. Imagine owning a piece of America's most valuable properties for less than $92 per share. That's exactly what you get with VNQ. This is a $34.6 billion fund, and that size tells you something important. Institutional investors, the big money managers, have massive confidence in this investment. They're not putting billions into something they don't believe in. Here's what makes VNQ special right now. It pays a 3.76% dividend yield, which means you're getting quarterly paychecks just for holding this fund. And get this, the expense ratio is only 0.13%, which means you keep more of your profits instead of paying them to fund managers. But what are you actually investing in? VNQ holds 159 different real estate investment trusts, giving you exposure to everything from cell towers and data centers to shopping malls and apartment buildings. You're essentially becoming a landlord to America's commercial real estate without having to deal with tenants or maintenance issues. The top holdings tell the story of modern real estate. You've got Welltower, which owns healthcare facilities. You've got Prologis, the king of logistics warehouses that ship your Amazon packages. You've got American Tower, which owns the cell towers your phone connects to. These aren't speculative plays. These are essential infrastructure assets that generate consistent cash flow. And here's the beautiful part. VNQ is already up 5.6% year-to-date in 2025, but that actually shows there's still room to run. It's not overheated, it's just getting started. When interest rates drop, real estate becomes a double winner. First, our EITs can borrow money at lower costs to buy and develop new properties, which increases their profitability. Second, as bond yields fall, that 3.76% dividend suddenly looks a lot more attractive compared to the shrinking yields on bonds, so more investors pile in, driving up the price. It's like real estate gets a double shot of espresso, property values rise, and those dividend checks become more valuable. This is your foundational play for the rate cut environment. Now let's talk about ETF number 2, and this one is the leverage play on rate cuts. I'm talking about the iShares 20-plus year Treasury Bond ETF, ticker TLT. Think of this as betting directly on the Federal Reserve's next move. This is a $47.86 billion behemoth that holds nothing but U.S. Treasury bonds with maturities of 20 years or longer. Right now, it's paying a 4.45% yield, and you get monthly income payments. But here's where it gets really interesting. TLT has what's called duration, and in this case, it's about 17 to 20 years of duration. What does that mean for you? It means this fund is extremely sensitive to interest rate changes. When rates fall, long-term bonds like these don't just maintain their value, they can skyrocket in price. Here's the math that matters. When interest rates fall by just 1%, these long-duration bonds can gain 15 to 20% in value. Let me say that again. A single percentage point drop in rates could potentially give you double-digit returns. On top of that 4.45% yield you're already collecting. Think about what's happening here. You're locking in a yield above 4% right now. But as the Fed continues cutting rates, new bonds being issued will have lower and lower yields. Maybe 3.5%, maybe 3%, maybe even lower. Suddenly, your bond paying 4.45% becomes incredibly valuable because everyone else wishes they could get that kind of return. That's when the price appreciation kicks in. The fund holds Treasury bonds from all the way out to 2053, so you're getting maximum exposure to this rate sensitivity. Now, I'm going to be honest with you. This is the most volatile of our 5 ETFs. The 5-year return is actually negative 9.18%, but that's because we've been in a rising rate environment. Every period of pain in TLT was because rates were going up. But now rates are coming down, and that's when TLT shines. This is your aggressive play. If you believe the Federal Reserve is going to keep cutting rates, and all the evidence suggests they will, TLT could be your biggest winner. Yes, it's volatile, but that volatility works both ways, and right now, it's positioned to work in your favor. Let's move to ETF number 3, and this one is interesting because it combines the best of both worlds. I'm talking about the iShares Preferred and Income Securities ETF, ticker PFF. This fund offers something unique, the stability of bonds with the upside potential of stocks. It's the hybrid champion of income investing, and right now it's paying a massive 6.35% dividend yield. Let me put that in perspective. That's significantly higher than most bonds, higher than most stocks, and you're getting monthly payments that hit your account like clockwork. PFF is a $14.68 billion fund that invests in preferred stocks and hybrid securities from 450 different companies. What are preferred stocks? Think of them as the business class of investing. When a company pays dividends, preferred shareholders get paid before common shareholders. If there's any financial trouble, preferred shareholders are higher in the pecking order. You get priority treatment, and you get paid for that priority with higher yields. The fund's top holdings include preferred shares from Boeing, Wells Fargo, KKR, Citigroup, and Bank of America. These are major established companies issuing preferred securities. Now, here's what makes PFF attractive in a rate cut environment. About 40% of the fund is concentrated in financial sector preferreds, and you might think that's a risk, but actually, it's an opportunity. When rates fall, banks and financial companies benefit because their borrowing costs decrease, and their preferred securities become more attractive to income investors. As Treasury yields drop, investors desperately searching for income start looking at these preferred stocks paying over 6%. That demand drives prices higher. The expense ratio is 0.45%, which is higher than our other picks. But when you're collecting a 6.35% yield, that fee is worth it for professional management and diversification across hundreds of securities. Many of these preferreds are trading below their par value right now, which means you're not just getting that juicy yield. You're also getting capital appreciation potential as they move back toward par. This is your income powerhouse, the ETF that pays you handsomely while you wait for rates to fall further. Now let's talk about ETF number 4, and this one has been absolutely crushing it. The Consumer Discretionary Select Sector SPDR ETF. Ticker XLY. When borrowing gets cheaper, Americans do what they do best. They spend, and XLY captures that spending perfectly. Check out these numbers. Up 31.88% over the past year, up 10.67% year-to-date in 2025, and with an expense ratio of only 0.08%. It's one of the cheapest ETFs you can buy. But here's the kicker. This fund is dominated by the companies you interact with every day. Amazon makes up 22% of the portfolio. Tesla is nearly 20%. And then you've got Home Depot, Booking Holdings, McDonald's, Lowe's, Nike, Starbucks, and Target, rounding out the top holdings. This is America's consumer economy in a single fund. When you buy XLY, you're betting that Americans will keep buying stuff. And when rates fall, that bet gets even stronger. Picture this sequence of events. Rates drop, suddenly car loans get cheaper, home equity lines of credit become more attractive, credit cards cost less to carry balances, mortgages become affordable again. What happens? People buy more from Amazon because they have more disposable income. They renovate their homes, so Home Depot and Lowe's see sales increase. They finance new cars, benefiting Tesla and auto retailers. They take vacations, booking through Booking Holdings. They even splurge more at Starbucks and McDonald's because their monthly budgets aren't as tight. Every percentage point drop in rates translates directly into consumer spending power. This ETF is already winning, as those performance numbers show, but rate cuts could absolutely pour gasoline on this fire. The consumer discretionary sector is cyclical, meaning it moves with the economy, and when the Fed is cutting rates to support economic growth, this is exactly where you want to be positioned. You're not just buying past performance. You're buying into the continuation of a trend that rate cuts will accelerate. This is your growth engine in a rate cut portfolio. Finally, let's talk about ETF number 5, and this might be the most contrarian play of the bunch. While everyone's chasing the big-name stocks, the real opportunity might be hiding in America's overlooked small companies. I'm talking about the Avanti's U.S. Small Cap Value ETF, ticker AVUV. This fund has quietly delivered a 19.27% annualized return over the past 5 years, absolutely crushing most large-cap funds. Right now, it's up 4.38% year-to-date in 2025, and it holds 776 different small-cap value companies. What makes AVUV special is that it's actively managed, meaning there's a team of analysts hunting for undervalued small companies with strong fundamentals. They're looking for companies trading below their intrinsic value, companies with solid balance sheets, companies that the market has overlooked or misjudged. The top holdings include names you might not recognize: Air Lease Corporation, which leases aircraft; GATX Corporation in railcar leasing; retail value plays like Macy's; energy companies like California Resources; and regional airlines like SkyWest and Alaska Air Group. These aren't household names. And that's exactly the point. Small companies are like speedboats compared to the aircraft carriers of large-cap stocks. They can turn faster, adapt quicker, and when conditions improve, they can surge more dramatically. Small-cap companies are more dependent on borrowing to finance their growth, which means they benefit more when borrowing costs fall. They're also predominantly focused on the domestic U.S. economy, making them a pure play on American economic growth. When the Fed cuts rates to support the economy, small caps often lead the recovery. Here's the contrarian angle. Everyone is crowding into the Magnificent Seven tech stocks, pushing their valuations to extremes. But smart money, the value investors who consistently beat the market over time, they're hunting in the small cap space where valuations are reasonable and opportunities are abundant. A VUV gives you access to their research and their stock picking, all for a 0.25% expense ratio. The fund pays a 1.58% dividend yield, so you're getting some income while you wait for these companies to be recognized by the broader market. This is your opportunistic play, the satellite position that could deliver outsized returns as rate cuts lift all boats, especially the smaller ones. Now, you're probably wondering, how do I actually put this into action? Let me give you 3 different approaches based on your risk tolerance. If you're conservative and prioritize stability, consider putting 40% of your allocation into VNQ and TLT combined for that foundation of real estate and bonds, 30% into PFF for high income with moderate risk, 20% into XLY for some growth exposure, and just 10% into AVUV as your opportunistic bet. If you're more moderate in your risk tolerance and want a balanced approach, shift to 30% in VNQ and TLT, 25% in PFF, 25% in XLY, and increase AVUV to 20%. This gives you more exposure to the growth and value opportunities while still maintaining that income and stability base. And if you're aggressive and really want to maximize your growth potential in this rate cut environment, go 20% each in VNQ, TLT, and PFF, then pump up XLY to 30% and AVUV to 30%. This approach prioritizes capital appreciation over income, betting heavily on consumer spending and small cap value recovering. Here's my recommendation on execution, and this is crucial. Don't try to time the perfect bottom. The Fed has already started cutting, and more cuts are coming, but you don't know exactly when or by how much. Instead, dollar cost average into these positions over 3 to 6 months. Maybe you invest 25% of your intended allocation now, another 25% next month, and so on. This way, you're smoothing out any volatility and ensuring you don't buy everything at a temporary peak. Then, set a calendar reminder to check your portfolio quarterly. When positions drift more than 5% from your target allocation, rebalance. This forces you to sell high and buy low automatically, which is exactly what disciplined investors do. Now, I want to have an honest conversation about risks, because I'm genuinely excited about these opportunities, but we need to be realistic. Nothing in investing is guaranteed, and these ETFs come with specific risks you need to understand. First, what if the Federal Reserve stops cutting rates? Maybe inflation picks back up unexpectedly, or maybe the economy proves more resilient than expected and they pause. If that happens, TLT and PFF could struggle because they're priced for continued rate cuts. Their valuations could compress and you could see losses. Second, what if the economy tips into a deeper recession? If unemployment spikes much higher and consumer confidence collapses, XLY and AVUV could get hit hard. Consumer discretionary stocks fall when people stop spending, and small cap companies can struggle more than large caps during economic contractions. Third, there's concentration risk in PFF with 40% in financial sector preferreds. If there's trouble in the banking sector, maybe from bad loans or regulatory issues, that concentration becomes a problem rather than an opportunity. And fourth, VNQ faces the risk of a real estate correction. If property values fall due to oversupply or changing work patterns or economic weakness, our EITs can decline even with lower rates. These are real risks, and I want you to go into this with your eyes wide open. However, and this is important, this is exactly why we diversify across all 5 ETFs. They don't all move together. When one struggles, another might be thriving. Real estate, long-term treasuries, preferred stocks, consumer discretionary, and small cap value. These represent different parts of the market with different drivers and different risk profiles. Based on current Federal Reserve signals, their stated concerns about the labor market, and the economic data we're seeing, the rate cut scenario looks highly probable. Jerome Powell has essentially told us what's coming, but nothing is guaranteed in investing. Markets can surprise us. Economic conditions can change rapidly. This is why position sizing matters, why diversification matters, and why having a plan for both success and failure matters. The Federal Reserve has shown their cards. They've told us rates are coming down. They've explained why, supporting the labor market and ensuring economic stability. The first cut has already happened, and the market is pricing in more to come. The question now is simple. Will you act before the next cut, or will you wait until everyone else has already positioned themselves and the easy gains are gone? I want to hear from you in the comments. Which of these 5 ETFs interests you the most? Are you leaning toward the safety of VNQ and TLT, the income of PFF, the growth of XLY, or the value opportunity in AVUV? Share your thoughts below, and let's discuss different strategies. If you found this analysis valuable, make sure you subscribe to this channel because the Fed's actions are going to create more opportunities in the coming months, and I'll be breaking them down for you. Hit that notification bell so you don't miss the next video because the next rate cut could happen sooner than you think, and you'll want to be prepared. One final reminder. This is educational content designed to help you understand investment opportunities and strategies. It is not personalized financial advice. Every investor's situation is different, with different goals, different risk tolerances, different time horizons. Always do your own research. Consider your personal circumstances, and if needed, consult with a qualified financial advisor before making investment decisions. The goal here is to educate you and give you ideas to explore further, not to tell you exactly what to do with your money. Now get out there, do your homework, and position yourself for what could be a very profitable period in the markets. Thanks for watching, and I'll see you in the next video.